Recording in progress.
Hey everyone, Daniel Snyder here. I'm gonna go ahead I'm hearing a little bit of echo here, so I'm going to our friends. There we go. Hey everyone, Daniel Snyder here. Thank you for taking the time to join us for this great webinar today with the one, the only Michael Kramer from Mott Capital Management, investing group leader here on Seeking Alpha for reading the markets. We're in for a treat. He's got tons of charts that he's put together for us. That's going to go over through all the macro indicators and currency indicators and swaps and spreads and everything that he's been watching as to what is going on now in the markets with this rally that we've all seen. Now, before we go ahead and dive into conversation with him, I need to get a quick legal disclaimer out of the way, so stand by. Past performance is no guarantee of future results. Any views or opinions expressed in the webinar do not reflect those of Seeking Alpha as a whole. Seeking Alpha does not take account of your objectives or your financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed security dealer, broker, U.S. investment advisor, or investment bank. Information provided by the investing group does not constitute investing advice, and investing group leaders are third-party authors that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Any content offered and tools on the platform are offered for information purposes only. And now, with that out of the way, I'm going to go ahead and bring the man here on the screen. I'm going to ask Michael Kramer to join us. And Michael, we got to start from the very beginning. For the people that are joining right now, which we have a sizable amount, some of them may not know who you are. So maybe let's start at the very beginning. How did you get into the world of finance and investing, creating Mott Capital Management, and to get to where you are today? Mike, you're muted. Why don't you go ahead and unmute for me there real quick?
Thanks for having me. So everyone, I am the author behind Mott Capital Management. That I know I have a lot of followers here on the Seeking Alpha platform, and I'm very grateful for everyone that's been with me over the last 10 years. It's been an interesting journey, and it's fun to go back and read how I started and where I am now, which is an interesting, I could have a whole conversation about that on itself. But I mean, basically, a long story short, I've been following the market since I'm about 16. I started in the mid 90s. I basically invested my way through college with money that I had gotten from my parents, and used that to pay for my tuitions. Basically by just investing, in the late 90s in that dot-com bubble and having experienced that. Obviously, I learned a lot on the other side of it as well. But I had a really strong passion for investing, and I really enjoyed it. So I went into the business. I started off as a trader, worked a little bit as an analyst, and I went back to being a trader, traded domestic and international equities, did that for about 9 years. And then in around 2014, I went out and started Mott Capital, and I started writing for Seeking Alpha about 10 to 15 months later.
Yeah, and we can't thank you enough. I mean, seem to be getting a little bit of echo feedback on. I'm not sure it's on your side or mine. We're gonna push through. So you've been writing with Seeking Alpha for a long time, and you watch all sorts of things in the macro environment. So what should investors be watching now, traders be looking at now, specifically in this market pullback we saw during the month of April and this ramp back into May?
So I'm gonna try to go through those actually in the beginning of the first couple of slides I have for you. But there's obviously a lot of things going on in this marketplace. This market's become a lot more complicated than it used to be, at least maybe from my vantage point. It seems like a lot of the things that I was doing when I was younger sometimes don't apply anymore, or it's just become a much more it's a quicker market. Options have obviously kind of changed things around a lot, and they've made it you really have to be able to look at the technicals, understand the fundamentals, understand the macro flows, and also be able to understand how option flows are really impacting things on a regular basis. It makes it much more challenging from that standpoint.
Yeah, so I know you brought a hey Mike, do me a favor real quick. Just go ahead and click mute and try to unmute again. I'm still getting that echo, and I'm sure other people are as well. But so for all the charts that you brought that we need to dive in today, I was hoping that you could go ahead. I know you have a whole presentation. Why don't you go ahead and share it here on screen, and we'll see if we can get through it with this echo.
Okay. So let me share my screen. So I have my own disclaimer, and it's basically just everyone could take a minute or so to read it. I'm a registered investment advisor. I'm registered in the state of New York. All of the opinions and analysis presented by me are, analysis of report solely my views, and readers should not treat any opinion, viewpoint, or prediction expressed by me as a specific solicitation or recommendation to buy or sell any securities. We're not going to be talking about individual stocks today. All this analysis is basically independent. I've done it on my own, and nothing can be complete or accuracy, and it should not be relied upon as much. Basically, nothing here is personalized, and you just need to remember that we're going through things. These are my opinions, and take them for what they're worth to you. So basically, if we just kind of start off with the first slide here, I think a lot of people, the biggest thing that everyone forgets is that in the first trade war, the first go around, we had that 2017 period where it was really good. We got off to a really good start. And then that trade war 1.0, where we basically did nothing from the January 2018 peak until October of 2019. And then things started getting a little more complicated in this area. But trade war 1.0, lots of volatility in the market, lots of big movements. This was a 20% decline. This was a good 12% decline. We had some 10% and 7% declines along the way. So I think what we're seeing right now in the market is at a minimum par for the course, and that we're likely to continue to see lots of volatility to come. And that kind of takes us to where we are in this market right now. And so when we look at the market right now, everything today happens so quickly from a standpoint of options and volatility that we see these big sell-offs really quick, just like we saw right now. And then we see these big snapback rallies. Everyone gets really excited. It's over. The worst is behind us, and everything can go ahead, right? And the way I try to think about things and present them as a writer to the audience is to not say the obvious, which is that, sure, the market can go higher, but try to present a view that is a little bit contrarian sometimes, to give people a heads up as to things that are happening deeper beneath that could be sending us warning messages about where we could be going. And right now what you've seen is basically what I call is a volatility crush. And at this point, all we've done is seen a major reset in implied volatility, meaning we sold off really hard, implied volatility went really high, and now it's coming right back down. And as a result, the S&P 500 has rallied. And that's basically what I think has taken place here. And this shows us, this is from optionschart.io, and what it shows us is that right now it's showing us a net delta exposure, which is basically giving us an idea of the amount of calls versus puts, and how the positioning in the marketplace is at this moment in time. And right now, as you can see, a lot of green is on the screen, and that's all indicative of calls. Now, if I had shown you this chart a month ago, it would have been flip-flop, meaning there was a lot of red on the screen. So what happens in this scenario is that you get implied volatility going really high, puts and calls, they go up in value, and then all of a sudden, as time goes by, put volumes decay, put premiums decay, call volumes decay. People who are long puts need to start buying them back. That starts sending implied volatility down. It basically creates a short covering rally. And that's what kind of gives us that big movement in the market that we've seen over the last month.
So Michael, how long does this go on for?
The positioning?
Yeah, the buybacks that you're talking about.
Well, and so I just went over this today with my group, because option expiration is this week, and basically once we get past OpX, that's going to reset, everything. So all of these call deltas, if you want to get into the mechanics of it, are going to diminish in value because the big OpX is gone for May. We're going to shift into June. All of these call values will come down. In theory, market makers are hedged against them, potentially by being long the S&P 500. And if they're long that needs to be sold when it's unwound. So it's possible, right? I'm not saying it's going to happen, but it's very possible that coming into Thursday and Friday and Monday, you could see a major reversal start in this market. And if you look at this chart, it's not as illustrative here because this is the net number. But if we were looking at the gamma exposure, which I don't have a chart of, the gamma exposure shows there's a lot of gamma that's built up at 5,900, and gamma is another derivative of option pricing, right? Gamma measures the change in the rate of delta. Delta measures the rate of change in a price of the option. And so market makers, again, are hedged against this 5,900 level, and that's why the market is stalling out here and may stall out for the next 2 days. And then you may very well see all of this begin to unwind and go back the other way. Does that help?
Yeah, and we're gonna do a little game of mute unmute on your side if you don't mind. It seems to be clearing up the echo a little bit. I'm not sure what's going on with the speakers over there, but yeah, I think that definitely helps because I think people are hearing what you're saying about implied vol in this option space, and it kind of feels like people are still up in the air a little bit. But it sounds like you're saying that these option flows are kind of what's making the market move how it is, and so next week, if I'm understanding right, next week people should really start to watch the price action to see then what happens, right? You got to unmute for me, Michael. I'm gonna go back and forth on this mute button here.
Yeah, I mean, honestly, it could start even tomorrow. It really depends upon how all this, if people go out and they have lots of puts and call, if they have lots of calls up at higher strikes and those calls start moving away, the market's not getting to those levels, it could start, sooner than that. This used to happen in 2021 a lot, about 2 to 3 days before OpX, you would see these volatility swings. And with implied volatility where it is, you have Jay Powell, let's say, talking tomorrow. He could say something the market doesn't like, or PPI comes in hotter and 10-year rates spike and you get a move up in the implied volatility. This could all start unwinding very quickly, and it could start, who knows, it could be tomorrow for all I know. But I think this is really what's contributed to this rapid rise in the market overall. And what I guess the next slide I have shows is that this is happening in a period of time when liquidity in the market is the worst it's been in 2 years. I mean, this red area and this green area is the top of book. So imagine in the old days here in July of 23, there used to be 10,000 contracts bid and 10,000 contracts offered on the for the bid ask, and the spread maybe was a penny. I'm just making something up. Today, back over on this side here, you can see it's really small and thin. There only may be 1,000 contracts bid and 1,000 contracts offered, but the spread and the cost to trade is also, instead of a penny, maybe it's 5 pennies. It's a nickel. And so what's happening is you get these pieces of news that come out, let's say at 6 o'clock at night, and all of a sudden, you see the futures jump 90 basis points on 15,000 contracts, and that kind of holds for whatever reason during the day. And what this is telling us really is that it doesn't take a lot to move the market at this point in time. And I've written about this more recently. And again, what this is kind of implying to me is that with this option dynamic that's been taking place and this lack of liquidity in the market, I think that's been really the primary driver as to what's been happening here. And really what's even more fascinating to me is that the volume levels are nothing spectacular. It's not like you're seeing a race to get into the market. The future contracts are actually trading below their 90-day moving average, which I find quite interesting. I mean, even during this period of time, I mean, look at the volumes that were really kind of moving through going into year end. But this just seems like just regular run-of-the-mill daily trading, kind of boring, actually. And so if we just keep going along, this is something I've started watching more closely. This is called the BTIC Adjusted Interest Rate S&P 500 Total Return Futures. And making a very long story short, because it's a very complex topic that I spent some time talking to people at the CME about, this basically measures your equity cost of financing, how much it costs to lever, one's portfolio if you're an institutional type investor. And basically these 45 basis points that we're trading at right now it's meaning that the cost of equity, the cost of financing stocks or your portfolio in the S&P is only 45 basis points above the effective funds rate. Now, in going into the end of the year, we had a few, there was everyone was going crazy. These contracts traded up to 180 and they soon collapsed thereafter after the Fed meeting. I remember watching the Fed meeting and seeing this literally happen in real time. And you were able to see that the cost of financing was just collapsing because market, whatever it was that the Fed said or the Fed did, the market finally woke up and realized they weren't going to get 8 rate cuts this year or something ridiculous. And the market said, we're paying, basically you're getting the Fed funds rate, which is 4.5, let's say, and then you're paying 180 basis points above that. So it meant you were paying about 600 basis points for that risk exposure, and that changed. But really what's more important here is what's happening with the divergences. And the divergence is rather notable. You can see the S&P 500 is rallying and the cost of financing is continuing to decline. Notice that during this period of time, market was up, cost of financing was up. Market was up, cost of financing was up. Market was up, cost of financing was up. Notice what happened in 2022. Market rallied, cost of financing fell. Market rallied, cost of financing did nothing. Market rallied, cost of financing went down. So this, to me, when I look at this chart, looks like this, and it does not look like this period in here, which is suggesting to me that institutional players aren't getting long additional leverage, and they may actually be still delevering their portfolios at this point. And I thought this was really interesting to watch and to use. And I've been using it quite a bit more recently as a guide along the way. The other thing that really stands out to us is what's happening in rates. Rates are moving up. In fact, what I find really interesting is that the administration has kind of talked a lot about, a priority to get 10-year rates down. And here we are now really above where we were on that panic Tuesday or whatever it was where Trump decided to pause the tariffs because you saw 30-year rates going over 5%, 10-year rates were going a little crazy. We're actually higher than that now. So I don't know how this plays out, but to me it would seem like rates are probably going to continue to go higher, and that's going to play into all of this as well. And one reason why I think you're going to see rates go higher is that you've seen in these regional Fed surveys and even the ISM reports, the manufacturing prices paid components, and again, this is all stuff I've written about, have gone to, levels not seen since, 2022, indicating that there is goods inflation building in the system. Now, everyone talks about how it doesn't show up in the CPI. Well, the black dotted line and the orange dotted line are the CPI and PPI, and you can clearly see they lead this by a few months. And so it's quite possible that we're not seeing those values yet showing up, which will really make it more interesting to see that import-export price that comes on Friday, because that may be telling us a little bit more about where inflation is in the pipeline. But this clearly suggests to me that there is inflation building in the system, and it's already been building for about 3 or 4 months. The other thing that suggests that rates can go higher from here is the term premium, which basically measures the cost that investors want for the added risk of owning 10-year treasuries. And you can look at this chart. The blue line is the median value since 1960s. And the red line is where we were in 2015. Term premiums have been depressed and suppressed because of quantitative easing and the Fed policy for years. And all of a sudden, term premiums are breaking out. So if term premiums are breaking out and we were go back to the median of about 1.4, about 1.5, and you added 80 basis points to where the 10-year is right now, you're talking about a 10-year at over 5.25%. So you're talking about, and this is just added risk. And so why would the term premium go up? Well, look at the budget deficit. Look at this tax bill they're trying to pass through Congress. You're talking about wider deficits, more debt, higher inflation. You're going to have higher rates. You can't have everything. You can't have low rates and be running a wartime or recession-like deficit and think that rates are going to go lower. So, this would be reflected in the term premium. And the fact that the term premium is rising has really nothing to do with the underlying fundamentals of the economy. This is just a guide for what investors are basically are saying they want an extra premium in owning a treasury. This chart is the dollar. And what's really interesting here is what's happening with the dollar, because the dollar is obviously falling really rapidly. And this, usually speaking, when you think about rising rates, falling dollar, you think about things like stagflation, or you think about things like, budget issues, things of that nature. And people have been arguing that higher rates are good because it means that the market is pricing in stronger growth. Well, that is true if the dollar is strengthening along with it. It's not true if the dollar is collapsing in price. And so the dollar has obviously been weakening quite a bit. And what this is telling us is that the market is either worried about stagflation, or the market is worried about the size of these budget deficits and the ever growing the overall debt in the economy. And why does this matter? And take it back to the S&P 500. Well, when you look at the S&P 500 and compare it to the yen, markets basically have been trading with the yen. It's diverged the last 2 days or so, but the market is basically trading with the relationship between the yen and the dollar, essentially, because here you can see it with the euro. All I did was invert at the scale. So, your euro high is 116 here, your low is 102. So I inverted it, and you can see again just further evidence that the market is trading along with the euro. And so rising bond yields, weaker dollar, stronger euro, stronger yen, kind of implies to me that investors who are foreign are selling US-based assets and moving them back, repatriating them back into their own local currency. And on top of that, you have other issues going on with, Japan, where they have a 4%. They just last night had a 4% PPI number, and 10-year rates in Japan are rising rather notably. And by the way, if there's any questions, just feel free to jump in and ask. But the 10-year rate in Japan is obviously rising very quickly, and that's causing the spread between the US 10-year and the Japanese 10-year to close. And when you take the Japanese yen versus the dollar and you take the spread between the tens, you get this overlay. Essentially, Japanese yen has been trading with interest rate differentials for the last 4 years. And so depending upon how this plays out, it's potentially an indication that the yen carry trade is due to unwind.
Hey, Mike, let's stop right here and address this. I'm gonna go ahead and mute you. So everybody hears about the yen. Everybody's hearing you talk about the euro as well, but specifically the yen. There's probably somebody here watching right now who may not know what the yen carry trade is, may not know why we focus on the yen and what's happening in Japan so much. Would you be able to just take a quick second and maybe shed some light there on that subject matter a little bit deeper? I'm gonna go ahead and ask you to unmute now.
So if we go back to this chart here, basically the yen has been the low-hanging fruit in the interest rate world for the last decade, meaning that rates in Japan have been at zero or below zero. You can actually see a period of time when they were negative. And essentially that creates, and this has been going on for a really long time, and it creates an opportunity, an arbitrage, right? So if you're an investor, you borrow in yen, you then use that low interest rate to then go and invest in a higher interest rate place, in this case being the US. And so, the most levered trade out there is basically had or could have been, which I'd like to write about, is you short yen, you convert that to dollars, you use those dollars to invest in NVIDIA. And if you really want to get crazy, you invest in NVIDIA calls. And that's sort of how this that's why this trade is so important, and that's why this trade is really kind of potentially falling apart, because it adds liquidity to the R markets, and it helps to boost asset prices here because people are borrowing in yen and they're enhancing their returns by investing them in U.S. assets. And so with this, carry trade potentially unwinding, that could mean again that you have risk that these assets are likely to be sold, especially if the borrowing costs in Japan continues to rise and the spread continues to narrow. It's not nearly as attractive to put that trade on anymore. And this chart just compares the S&P 500 to Treasury rates. For the most part, we had been trading inverse to Treasury rates throughout most of 22 and 23. And then sometime in this period of time, we started trading with Treasury rates. And you can see more recently, we've been trading with Treasury rates as well. My guess is that this is going to have to go back to uninverting and being more like this again. But because right now the market's thinking that higher yields are positive for growth, I don't think it's caught on to the idea that this is more of a stagflation problem than it is a positive for growth. I mean, that's what the dollar would suggest. And so going back to the yen carry trade, what also we're looking at here is what's called the Japanese yen cross-currency basis swap spread, and that's in black. And the red is the US dollar JPY. And so when the funding was down here in 2022, it was very easy to obtain yen because there was a dollar funding squeeze. Dollars were in really strong demand, so you were paying a lot to put on a dollar hedge. Now at this point, it's much cheaper to get dollars. Dollars are easily accessible. It's not as favorable in yen terms to now go out and put on that yen carry trade, and that's another reason why the yen carry trade could be, sort of in trouble here. But you can also see that, basically the yen had been weakening throughout this entire period, but it wasn't really stopping anybody from putting that trade on. But now all of a sudden that's starting to reverse some. And then, of course, again, there's this relationship which measures the cost to finance or the cost to hedge your Japanese yen carry trade versus the S&P 500. And I think this is probably the clearest chart that shows the relationship between the yen carry trade and the S&P 500. But what I find really striking and interesting here is that they've been following each other for a very long time. But you've noticed here we went up and we came down while this just went up. And so, if this relationship continues, we should see this come down as well. And then, of course, where this trade goes from here, which I don't know, will depend a lot on where interest rate differentials go and things of that nature and what happens with this crazy trade war. That may determine where the liquidity is heading. And right now it was telling us liquidity was very tight in the U.S. Dollar funding costs were very expensive. Then, of course, liquidity came back into the market, and now it looks like it's starting to go through a process of leaving again. And this is basically, again, a measure of the liquidity and how it played into credit spreads. So this is a high yield credit spread index in price, not in terms of the spread or the basis points. And again, it's just showing you the relationship between the two, how when liquidity was tightening and liquidity was tight in the U.S., credit spreads, credit came down in price, meaning spreads were widening. And as liquidity improved, the price improved as well, just like the stock market did. And this chart actually shows you the credit spread, which is the high yield spread in black, and in blue is the S&P 500 earnings yield, which is basically the inverse of the PE ratio. And so when you put them all together, you get the same trade. We touched on this slightly in June when we were doing that live conference. I said to you we were at the same trade. The only thing at that point is that because I'm always learning and reading and teaching myself new things, I hadn't come across this Japanese yen and how it tied into all of this. And the funny thing is that when you go over to it's the same trade when you do it with the euro. And this is all the same stuff. And so why does it matter? Because it plays back into implied volatility. Credit spreads, all of this stuff. And so basically, why did implied volatility go up? Because credit spreads widened, because liquidity tightened. And so if we're going to go through a period where credit spreads, liquidity is going to tighten, credit spreads are going to widen, you're going to have higher volatility, and you're probably going to have lower earnings multiples, which really takes us to the end of the slideshow, which goes through everything that kind of summarizes everything here. And that was a lot, I know, in a half an hour.
Yeah, no, this is great. I just threw back on mute again. I think this is really great. Everybody can see here your bullish case. The bullish case for the rest of the year is that all the problems go away. S&P 500 makes new highs. The bear case is that the U.S. enters recession, multiples contract, and the S&P 500 falls below 4,500 level. And then your base case is U.S. goes into the quasi-stagflation, higher U.S. rates, weaker dollar. S&P 500 range between 4,500 to 4,800 is what that looks like. Correct me if I missed anything there, but wanted to ask you a quick question because it sounds like you're kind of watching the credit spreads, and I think some investors and some people here may not understand like how you get that data, how you get that information, and how they might be able to keep an eye on it as well. So could you just take a moment and share with them how the everyday person could keep an eye on what credit spreads are doing?
The easiest thing is to look at the ratio. What I tell my readers to use, so they want to always know, it's a rough estimate. It's not meant to be exact. There's a couple of different ways you can do it, but what you find over time is that a spread is a spread. It's just called something different. You can take a German 10-year and subtract an Italian 10-year, and you get a spread, right? And when that spread is really tight, like it is right now, it tells you that high yield spreads are likely tight. It tells you that liquidity is probably ample in the system. You could also do a ratio of the SHY, which is I think a 0 to 2 year ETF, and then divide that by the HYG, which is the high yield ETF. And that gives you another sort of way to look at that spread. Again, they're not exact. They don't mimic it every day in the same exact way because there's always these little variables. But over time, the trends are close enough that if you're just trying to be a casual observer, you can do that. The other way, you can just go to the Fred website, which is the St. Louis Fed. It's called Fred, F-R-E-D. And you can just look up the ICE B of A high yield option adjusted spread. And it's the same credit spread. And that only updates once a day at the end of the day. And usually it's a day lag.
All right, duly noted. Now I'm going to take a quick second, and obviously we're on this webinar because you have your service here on Seeking Alpha called Reading the Markets. Want to go ahead and encourage everybody to check out all the work that you're doing. You're always putting out updates exactly like this, as you mentioned on your call earlier. I would ask the team in the back if you could just drop the link in the chat, and if you're watching the replay, that link is right below this video as well. Now, I want to dive into some Q&A because there's been a lot of questions coming here in the chat. People want to know what you're recommending, where's the best place to invest, that sort of angle. So we actually have one here that says, where does recommend is the best place to invest now? Sounds like foreign markets is the best place to be. Don't know if you have any thoughts on that U.S. versus foreign investment approach.
So I personally, don't. I don't like to give out those types of calls, right? But I've read a lot of different people talking about opportunities to be invested in some of these markets. I mean, when you think about what's happening in Europe, there's obviously lots of spending going on there, and you probably want to think about, ways to maybe play that. The things that I've been thinking about for myself have been looking at ways to play that maybe through financials, maybe play that through, infrastructure plays or defense. But, again, like I can't really be more specific than that.
All right, appreciate that. Now we've got Conrad here. Looks like he's joining from Poland. Thank you for taking the time to hang out with us. Says, "Hi, Michael. Given the rising U.S. 10-year yields, I just lost the question. Give me 1 second. Given the rising 10-year yield, well, and the recent stabilization in BOJ policy, do you see the USD JPY breaking above 148.80 as a true technical breakout, or could gamma positioning and resistance near 149.150 create a short-term pullback? Thank you so much for your brilliant insights as always. Really appreciate your time and clarity."
So I really am of the view that the yen is going to continue to strengthen versus the dollar, because I think that the BOJ is going to have to continue to raise rates. And so unless the 10-year breaks out to the upside, you really start seeing rates moving to the upside here in the US. I think it's going to be more likely than not that you're going to see the yen break below 140 at some point and start really strengthening towards that 130 area. That's just how I've been kind of thinking about it more recently. Again, that could change, but it's going to be, I think, really largely dependent upon how the BOJ handles the inflation and everything going on over there.
All right, we got another question here. It says, "Please comment on the rollover of corporate debt that was originated 5 years ago in a zero interest rate environment, and how does that get done today?" Going back to what you're talking about with where yields are, I mean, even seeing the rising yields this week come across the tape, I think a lot of people are interested on your thoughts on that.
So that's been a topic of conversation, I feel like, now for some time. And it may even partially be why, you've seen spreads sort of at historically low, or I should say really historically tight levels. But clearly it's going to play a the high rates itself are going to be a problem. And the bigger issue that I see is how the Treasury is going to roll over nearly a quarter of the debt outstanding we have over the next year, because so much of it is issued at the front of the curve, and they've made, sort of a point of, we need to get the 10-year rate down, and the 10-year rate's going the other way. How are they going to do that? Are they going to continue to issue it at the front of the curve? Are they going to just have to bite the bullet and start issuing more debt on the back? Are they going to try to do something with the dollar? That's really, I think, the bigger problem right now, or the bigger question, I should say.
Sounds like a lot of this is going back to just like an overall theme of where's the liquidity going? And correct me if I'm wrong. I mean, from the CME tool that you showed us earlier to thinking about our company's going to re-up their debt. I mean, this seems like liquidity is in the front of everyone's minds right now. We got a great question here about oil. It says, if oil falls to between $40 to $50, doesn't that mitigate inflation?
So interestingly, oil going down, sure, would be bullish in terms of inflation coming down, but oil at 40 to 50 probably means a lot of shale producers here in the US are really going to struggle. And I think we went through something like that in 2016, and that ultimately led to credit spreads really widening quite a bit. And so while oil would be good for inflation and maybe the average person at those places, it wouldn't be good for most of the US suppliers and producers of energy, from what I understand. So it's going to have a double-edged sword.
Right. So let's jump into this next one here. Kevin's asking, given the pullback in the tariff rates, so we haven't really talked about the trade war, right? We got to talk about tariffs and trade, obviously, because that's affecting a lot of not only sentiment, but now we're seeing the one UK trade deal, potentially more coming as soon as this week. It feels like they're saying that every day now. What are your thoughts on the trade war, with how tariffs are coming in and how that trickles into the inflation? And when could maybe people start to see that actually show up in these inflation prints?
Yeah, so the trade war thing is interesting. We obviously have a baseline of 10%, or that's what it's supposed to be. I think the market hasn't really fully appreciated it yet. I think it's likely that you're going to see those higher prices probably not hit like something like CPI until maybe July or August, but you may very well start seeing them in things like import prices starting on Friday. And so I don't really know that we're going to escape that. At least there's going to be, I think, at least a one-time bump. And maybe it's not a long-lasting inflation, but I think there's going to be at least a one-time bump. But more importantly, and I think the market forgot all about this, and I'm going to share my screen and go a little bit off topic or off prepared slideshows, because I think this is important. So let me just move things around a little bit here. And so this is my trading view. And the interesting thing, I guess, is really more so here is the Taiwan dollar, right? Which everyone knows that the Taiwan, in Taiwan they export a lot of chips, and there's something. I mean, this is when this comes down, that's an indication. It's like the yen is quoted USD TWD, so it means it's strengthening versus the dollar. And just to give you a little bit of perspective in terms of how big this move has been, this is the weekly chart going back a really long way, and you can see that right here. This is huge. This is a very, very big move in a currency we should never really be talking about. And, the timing of it, I think, is even more interesting because this all happened really over the last couple of days, where this big move was May 2nd, and this was May 5th. And so regarding the trade war, I've written an article on this for the premium website talking about how you're seeing these very big moves in these Southeast Asian currencies. And here's the Korean won, and you're seeing these very big moves in these chip exporting economies, and the Section 232, which was the investigation the Commerce Department put on semiconductors, that public comment period closed on May 7th. And so we're waiting basically to see if we get semiconductor tariffs. Remember, the semiconductor tariffs were excluded from the reciprocal tariffs because the idea was that Trump was going to bring sectorial tariffs. Now, he's done that with aluminum and steel. He's done that with autos. He's talked about pharma, but he also is going to do it with chips and everything that is chips related. And this movement in the Taiwan dollar could very well be due to preparation for that, because what I've understood is that there's about $1 to $2 trillion here in the U.S. that are invested from Taiwanese type life insurers and pension funds that are not hedged. And so it's quite possible they're bringing them home, that money home. So I was reading this in a Taiwan article from a Taiwan newspaper this morning, and because I'm trying to figure out when this announcement's going to be with these semiconductor tariffs. So there is something going on, and I don't think we've seen the end of this tariff thing yet, and I think there's probably more behind it still to come. Now, I could be wrong. I could be trying to connect all the dots, and it leads us nowhere. But I just find the timing of all this very suspicious.
Well, I think we all need a Rain Man, if you will, that's trying to connect all the dots. So we appreciate the effort. We got a couple questions here about what are your views on the gold market? Obviously, the gold's been rallying, right? We just had George Milling Stanley on ETF Spotlight talking about the GLD ETF that he created way back when, and getting his views on gold. And it seems like everybody's very bullish on gold, but we're starting to see this pullback with, of course, the market pop. Is that the correlation there? What are you expecting from here?
Am I unmuted?
Yes, you are.
Oh. So I was looking at gold this morning, actually. And what's interesting about it is when you look at the technical chart here, you have your typical bump and run pattern, right? Here's your long-term uptrend. Here's your secondary uptrend. You've also formed what looks like a double top pattern. So if you extend the double top pattern down, it takes you to 3,000, which would take you below the uptrend, which would suggest you come down to this 2,900 region. And so there could still be a little bit further from a technical standpoint only that gold maybe still has a little bit more to go to the downside. longer term, I think gold is proving to be an important asset class that's probably been largely neglected, especially if you're going to be in an environment where interest rates continue to rise. There is now no true hedge out there for people who want to try to protect their assets. It used to be treasuries, but treasuries may no longer be the case, and so gold may take that place if this thing with treasuries continues to develop. But I think over the shorter term, it probably has a little more downside to it.
Do you think crypto's a hedge?
I don't really believe in crypto. I don't know how to value it. I've heard lots of stories about how important it is and how Bitcoin has a network effect. I've heard a lot about it, and I don't want to get into it too much, but I'm not a believer of it. I'm sorry to say.
We had to ask. That's all right. So we had a comment question here about, do you think that central banks will eventually intervene in the currency markets, as we have seen from the Japanese central bank? Any thoughts on that continuing throughout the world?
Um, I don't. It's hard to say. It depends on what the problem is. I mean, if you're talking about the Fed, I don't think you're going to see QE from the Fed for a very long time if it ever comes back, um, because number one, you're way off the zero bound. It's only really used as a tool when rates get to zero, unless there's some sort of major market dislocation where the Treasury market really starts breaking down and not functioning correctly, where bids and offers sort of just vanish. You're probably not going to see the Fed intervene in something like that. It's possible that the Bank of Japan continues to do what it does with the yen, but I think right now, at least when you look at the yen, I mean, certainly it's been finding a floor magically at the 140 level, and again, partially due to interest rate differentials, but ultimately, these markets that do this interest rate in this intervention in the FX market, I think, should really only be a tool if there's really a major need for it. I don't really see why they should be at this point. And I don't think the Eurozone really, again, I don't think we're really close to like a QE type thing there either.
So just to clarify from earlier, do you think we're in a period of stagflation right now?
We're either very close or we're going to be there. It really depends, because we don't really know what the first quarter was like, because there was so much import pull from the fear of tariffs, and so that made that GDP print really weak. But I think that we could be heading towards stagflation, only because and so the traditional term for stagflation is rising interest rates, high inflation, high unemployment. So that's why I call it a quasi stagflation, meaning I think we're going to have okay unemployment. Maybe it gets to 5%, 4.5 to 5. We could have this sort of like 3 to 4% inflation rate, and we could have this, if tariffs really have an impact, could have that 0 to 1% growth. And so that's going to make things feel really bad, but it's not really going to be like a full-blown 1970 style thing, if that makes sense.
Yeah, it definitely makes sense to me. Thanks for clarifying on that. So here's another question, because I saw a couple come in about the US dollar, strong versus weak. Do you have a thought on what the administration is trying to do with the USD dollar specifically? Because traditionally we've always told that it's in the best interest that America has a strong dollar, but then you start looking at debt payments and everything else with how it all is correlated. Just kind of curious, do you have any thoughts?
So interestingly, today at 12:40, there was a leak that read, "The U.S. is not seeking to weaken the dollar as part of trade deals." Source: according to people familiar with the situation, U.S. officials negotiating trade deals around the world are not attempting to include currency policy pledges in their agreements. So I guess there was some fear that things like what was happening in Taiwan has something to do with a policy pledge, or the government trying to say they're going to strengthen the dollar, the Taiwan dollar weakening versus the U.S. dollar in order to kind of shrink those trade imbalances. That apparently is being denied. So I don't really know. I mean, they say one thing and then they do another. We're not going to pause tariffs on China, then they do. I don't think we're going to cut the tariff on 145%, and then they do. So who knows?
All right. I mean, that's a solid point. Nobody can read the future like that. Michael, I'm going to go say, let's go ahead and wrap it up. It's been a pleasure talking with you. I mean, the amount of data you bring, the framework of your mind. If you wouldn't mind, go ahead and throw up that summary slide one more time on the deck, and we can just make sure that everybody has a second to review that, what your bear case, bear case is for the rest of this year. Everybody, if you haven't checked them out already, go check out Reading the Markets. Can't encourage you enough. I mean, every week after week, you're posting new charts, new data, what you're watching, how it all breaks down, how it's all correlated. I mean, as I mentioned, we're all looking for that Rain Man, and maybe it can help you out with your investing strategy and portfolio. But everybody, I'm Daniel Snyder. Michael, do you have anything to say to the people that joined us live real quick?
I appreciate everyone that takes the time to read my work and gets what I'm trying to do. It's obviously not easy, but the point is to try to learn and try to understand how the markets interconnect and what that might mean for where things are going in the future. And look, if I can help someone just learn something new, I feel like I've done what I'm out to do, at least, and that's really what matters the most to me.
I will also mention you built a great community, not only on Seeking Alpha, but all across the internet. So everybody go look for Michael Kramer. And once again, thank you for joining us. This has been another great webinar. We hope to see you in the next one, and take care and be safe out in those markets. Talk to you later.